Today's jobs report was jobs light. We're also lighter on the work week, lighter on wages. Wasn't what I would call a spectacular report. Your thoughts?
Yeah, it was pretty tepid, but from the Fed's perspective, it fits their narrative perfectly, right? We have economic momentum in that 145,000 jobs created is more than the run rate that would keep the unemployment rate unchanged. We have pressures on resources because the 3.5% unemployment rate is below the natural rate of unemployment, and we don't have evident cost and price increases picking up. So that means that they can run monetary policy the way they want to, which is keep the policy rate unchanged all this year.
You know, yesterday, Dallas Fed President Robert Kaplan talked about a bit of nervousness he's having regarding fueling excesses with the growing balance sheet. Thursday afternoons, of course, you know, we see that balance, and it was approaching $4.2 trillion. And the Wall Street Journal had an article today that over a 12-month plus period, 40% of listed companies are losing money. They highlighted GE and Tesla. Wrap all that up for me, because it doesn't sound to me like that would be the type of foundation to see stocks at this level or remain at this level.
Sure. So there's a couple things going on. One is, I appreciate the shout out to the H41, which is the Federal Reserve release where you can see it every Thursday afternoon, that monetary policy shouldn't be measured just by the basis point terms of where the Fed funds rate is. You should look at the size of the balance sheet. And the Fed has made its balance sheet big. Its brief experiment in shrinking the balance sheet didn't work out the way they wanted. The big issue is big banks want to sit on reserves, and that's probably distorting the front part of the yield curve, i.e. in money markets. That when the Fed did run off reserves, we had the volatility in September, and they backed off really, really fast. I think the concern for President Kaplan is expressing is, what's the plan? Is it just keep shoveling reserves to keep the market quiet, or to implement a new strategy? Now, when you're talking about valuations, and it really does feel like it's a risk-on environment when you look at equity values and risk spreads, you want to step back. And basically what happened in the last part of last year is the bad things we were worried about didn't really materialize. There was phase one of a deal with U.S. and China, a passage of the USMCA. The impeachment process didn't change anyone's mind. And so some of the bad risks to the outlook have kind of shrunk in some. Yeah, the world's a risky place, and we're going to be talking about the presidential election 24/7 in a couple months. But right now, it's a window for risk-taking.
Now, you know, let's encapsulate this in a very simple form. We have many excesses growing. That's undeniable. Whether stocks can stay here amidst that or not almost is a peripheral issue. Weigh that against the solutions versus just patching things over. We have an issue. It's been after the credit crisis, how things like treasuries and munis and various collateral of high quality are treated, how they're hoarded. Reserves, of course, are paid interest, and all this has really clogged up the plumbing. Just because we're pushing more pressure through doesn't fix the pipes. Your final thought.
I think what you've done is just characterize the Federal Reserve as a serial bubble blower, right? In its effort to keep macroeconomic outcomes on an even keel, it does have to create excesses in different markets. And that's the dirty little secret of monetary policy. They hope they can keep that under control by their supervisory policies, but they don't quite have that right, because what they've in fact done is create an elevated demand for reserves. They can make their balance sheet big because they've made big banks want to hold reserves.